You look at the digital asset markets today, July 1st, 2026, and I mean, it is just a wall of red.
Oh, yeah. Absolute carnage on the surface.
Right. Bitcoin just systematically hunted stop losses down to, was it $57,717? And the fear and greed index collapsed to a pretty bleak 15.
Yeah. And June just wrapped up with a record 4.51 billion bleeding out of U.S. spot ETFs.
Yeah.
I mean, BlackRock's IBIT alone bled 212.4 million in a single day.
Exactly. The surface data screams absolute panic. But, we are bypassing that surface noise for today's deep dive.
Right, our mission is really dissecting the extreme structural mechanics operating underneath all this panic.
Because when you look at that ETF exodus, it doesn't actually look like investors fleeing a sinking ship. To me, it looks more like, well, you just spotted a better cruise liner.
Yeah, an institution is just moving cash out of a volatile tech portfolio and into a guaranteed high-yield savings account, simply because the bank suddenly spiked the interest rate.
Right, and that's Kevin Warsh, right, the newly appointed Fed chair.
Exactly. He made a highly hawkish debut at the Sintra Central Banking Forum. By deliberately withholding forward guidance, he basically drove the U.S. dollar to a 13-month high.
Wow. So if you are a fiduciary managing institutional money, you don't really need to stomach asset volatility. Not when a 5% Treasury bill offers a totally risk-free alternative.
Precisely. But here is the fascinating part. While traditional finance is retreating to the safety of treasuries, they are simultaneously building massive, new digital asset infrastructure.
Like OpenUSD or OUSD. That's the new dollar-pegged stablecoin backed by over 140 enterprises.
Yeah, heavyweights like Visa and BlackRock. Because they aren't retreating at all, they are optimizing. OUSD is just a perfect example of TradFi weaponizing market structure.
Right, against native crypto companies. Because historically, a company like Circle built its massive valuation on, hoarding the yield generated by the fiat backing USDC.
Exactly. And OUSD completely breaks that monopoly. It actually shares its yield reserves directly with its consortium members.
Oh, wow. So by structurally re-engineering who gets the yield, they immediately eroded Circle's competitive advantage.
Yeah, and that mechanism alone tanked Circle's valuation by up to 16% on the announcement.
That is wild. But okay, let's pivot to the really big story today, the SATA trap.
Yes, we definitely need to spend some time here.
Because what Strive's CEO, Matt Cole, just engineered is a literal masterclass in market mechanics.
It really is. So let's break down the architecture of SATA. It originally operated with a variable rate perpetual structure.
Right, so basically an asset with no maturity date, but an adjusting interest rate.
Exactly. And more importantly, it had a hard-coded par value cap of $100.
Okay, meaning anytime the share price hit $100, the protocol would automatically issue infinite new shares to push the price back down, right?
You got it. So if I am a short seller, that is a dream scenario.
Oh, for sure. Because mathematically, your maximum potential loss is capped at $100. It's like a built-in safety net.
Exactly. And Wall Street heavily exploited that net.
Yeah.
Short sellers aggressively piled in, borrowing 1 million shares.
1 million.
Yeah, 1 million. But by doing so, they drove the annualized borrow cost up to a staggering 70%.
I mean, if I'm shorting it, I don't really care about a 70% borrow fee if I think the underlying asset is going to zero, or, if I know my upside risk is structurally capped.
Right, until the CEO unplugs the machine.
Wait, how did he do that?
So Matt Cole recently launched a public shareholder poll on X.com about halting that $100 issuance cap.
Oh, wow. So as the CEO publicly signaling the removal of that hard-coded ceiling instantly prices in a structural shift.
Exactly. The safety net just vanishes without the automatic dilution at $100. There is no artificial price ceiling anymore.
The asset can theoretically go to infinity.
Right. So overnight, you have short sellers trapped holding these toxic positions that cost them 70% year to maintain. And now they face unlimited upside risk.
That is incredible. It perfectly engineers a targeted short squeeze.
It really does. And it completely reframes the recent steep drops in SATA's price, too.
Right, because those drops weren't due to fundamental credit flaws at all.
No, not at all. They're purely leverage-driven liquidity events. Basically, the mechanics of a trap snapping shut.
So for you listening, the real takeaway today is realizing that architecture is the modern battleground.
Exactly. While retail traders are obsessing over the fear and greed index, institutional architects and corporate strategists are quietly rewriting the mechanical rules of the game.
Yeah, to trap their opponents. It really forces you to look at the broader market through a completely different lens.
It really does.
Which leaves you with something to ponder. If a CEO can successfully weaponize their own Treasury vehicles' mechanics to hunt and squeeze institutional short sellers, how long until other publicly traded companies start re-engineering their own stock structures to fight Wall Street manipulation?
That is the billion-dollar question.
The blueprints for the trapdoor are out there now. You just have to wonder who is currently installing the next one.